looked at the residential side. We identified subsets of the residential sector in the UK where we saw great value. A lot of low-hanging fruit, trying to identify quick turnarounds that hits your target return is no bad thing.
Especially if you can cash out or trade out of something quite quickly at a super profit.
We were, looking back, a bit naive in our presentations. We say this is a great time. The market is very volatile. Values have fallen a lot. It's a great time to invest. And we went to see a number of investors, LPs, institutions, who said that's all fine and well, but
Linus, welcome to the podcast. It was about 10 years ago when we first met, when you had your office in Lime Street, and I was new to the world of headhunting, and I remember meeting you and a couple of your colleagues to talk about a particular instruction. So that's when we first met, and it's great to come full circle and get you on the podcast. So thank you so much for joining me today.
Thank you for having me. Time has flown since then.
It has.
A lot has happened.
A lot has, and I'm excited to hopefully unpack a little bit of that today in terms of our conversation. But a place that I always like to start these chats is if you can throw your mind back. Can you tell me about how and why you got into real estate in the first place?
I grew up in the north of Sweden, in a city the size of Cambridge, and my father and the family on that side had been in real estate for a couple of generations, so I unknowingly was probably influenced running around construction sites and buildings in my youth. I wasn't that focused on that, I must admit, similar to what a number of your other guests have said. I was more focused on sports during my early years. But at some point, I think I was 17, 18, my mother convinced me that there was no money in sports. This was the early 90s, so it's times have changed, but she encouraged me to focus a bit more on my studies, and I did. And I think she wanted me to be a doctor, but I looked at that and I thought that's probably not for me. And my father, I got to spend a bit of time working for one of my father's companies, and I thought real estate sounds interesting. Now that I've maybe matured a little bit, and so I did a bit of time working there before and after my military service, and decided to apply to a program in Stockholm for real estate economics in the mid-90s.
So what sports were you into growing up?
I tried pretty much everything. I think when I was 9, I wrote in school, you were asked, what do you want to be when you grow up? And I wrote number 1 was Formula 1 driver, number 2 was ice hockey professional, and 3, I think, was golf professional. And I played football, golf, skied, but ice hockey turned out to be the thing I really went for, and I enjoyed that. And it was a sliding doors. I think somebody was talking about on another podcast, and it felt very much like a decision I made then when I was 17, 18, that actually probably a professional career is a smarter bet than trying the world of sports. And
so you touched on the fact your family or your dad had been in real estate. Which part of the real estate space had he been in?
So the family had a construction business, a real estate business, infrastructure, so a few different parts of it.
So you got exposure, around the dinner table growing up, talking about different deals or projects, or? I
was forced to go in the car regularly on the way to wherever we were going to look at properties or sites, and so I did get a fair bit of exposure.
And that was Sweden, in terms of the kind of the portfolio or the business, it was focused on Sweden, was it?
I was in the north of Sweden. And
so your mother convinced you to go to university, focus on your studies. What did you say you studied at uni?
It was the Royal Institute of Technology in Stockholm. So I think the degree was called Real Estate Economics, and with maths. And so I did that for 4 years. And I was lucky in that I got to work for a large real estate company in Stockholm, in internships over summers and alongside my studies. And it was really useful because I got to sort of apply the things you read about in the books to real life situations. And I enjoyed that. And the one area that I was particularly interested in was finance, and a little bit randomly, I ended up going to LSE to do a master's in real estate finance in the late 90s, which was an exciting experience. Coming from the north of Sweden to Stockholm was sort of wow, and then coming to London was fantastic. It was a great city, and I met some fantastic people, and it really opened my eyes to the world.
So you touched on your mum told you to focus on your studies. You're very occupied with sport, doing lots of different sports. In terms of your kind of academic background, were you particularly academic? You just didn't necessarily focus on it? You just had more enjoyment in the sports piece? Or
I was certainly more focused on the sports. I remember a couple parent-teacher meetings with my mother and my teacher, one of my teachers, where they were both looking at me, shaking their heads as like I need to apply myself more. And I was lucky in that it wasn't, some of the subjects came quite easy to me, quite naturally, but it wasn't until I was sort of 16, 17, 18 that I started to spend more time on it, which was necessary. I remember a maths test in upper secondary school where I spent probably more time counting how many points I could possibly achieve on the test that I had answered questions. So I'd realized at that point it's actually probably good to put a bit of effort in.
So you put a bit of effort, but you had a natural predisposition to kind of numbers and finance as well?
Probably, yes.
So you came over to London. Is that post your year of national service?
Yes, you do that before university in Sweden.
So you did that before. Can you just give a bit of context to that? Because people over here in the UK obviously don't have to do a year of national service. But it is still quite common, or has been common, for a number of Europeans to do that still.
Yes, it was, when I did it, it was probably the last or the penultimate year that they had the mandatory national service. So then with budget cuts and things, and then the view that the world was now safe, Sweden decided actually we don't need this anymore. And I haven't lived in Sweden for a long time now, but my understanding is that they're starting to reintroduce it in light of the geopolitical tensions around the world. But it was. I wouldn't go back and do it. Like if I had to do it now, I wouldn't be that excited about it. But it was formative. And it was a great way actually to teach you discipline and to deal with situations with people you wouldn't necessarily hang out with on an average weekend growing up. So it was people from all over the country, and it was it was. I'm glad I did it.
Looking back, you're glad you did it, and it helped, no doubt, with your move to university and then to do real estate finance at LSE.
Yes.
So from there, what was the thought process having kind of graduated? You got your real estate kind of badge. What and how did you kind of actually land your first role?
So after as you sort of halfway through, and it was interesting in Sweden, the whole infrastructure around applying for jobs and writing CVs and things like that career days it wasn't, and I still don't think it's such a developed concept. And a number of my friends in London when I moved there were from the US, and I was blown away by how focused they were on this and how good they were at CV writing and preparing for interviews and everything. So I was okay, that's probably something I should try. And so I managed to get a couple of offers from different companies in the UK. I had offers to go back to Sweden. In the end, CBRE made me an offer to join their London office, but spend a bit of time in London and then go to Madrid. I tried to get to Moscow as a third placement. They decided that wasn't wise, so they sent me to Frankfurt instead, and then I went back to Madrid. So that was where I worked in fund management and capital markets team, and that was a very exciting time and a fantastic experience.
So was that on an advisory basis, or were you kind of working on like CBRE Global Investors?
So I worked in London. I worked for what was then CBRE Investors. in Madrid and Frankfurt, I worked for the advisory, the capital markets investment agency teams.
And did you get your letters? Did you qualify as a surveyor, or was that not the route?
No, it's. I found it interesting when I started working when I started working in London for CBRE investors that the RICS was a big thing, and not having come through that route and that background, it was something that I debated. But I because I was only going to be here for a little while and then moved for sort of 8-9 months and then moved to abroad, I thought it's probably not for me. And I remember that A, being a Swede, B, not having gone through the traditional university route that most people in the market had, I was a little bit of an anomaly, and it's interesting to see how much the industry has changed since those days.
Just in terms of kind of international kind of students or individuals coming to kind of work out of London or London domiciled firms?
I think there are great benefits to diversity of thought, and what I think the real estate industry in the UK has very much opened up. And then I remember when I joined, there was also a gentleman that came across from Goldman Sachs who brought a very different perspective, and it was encouraged by CBRE investors in Los Angeles, where the head office was at the time. And I think that some of the great things about the UK and some of the great things about London is that rich sort of diversity of thought process and educations, experiences, professional backgrounds. And I think that the real estate industry is richer today for benefiting from that, and then having opened up a little bit from what I think people used to call it a little bit of a boys' club, maybe. And I think that has changed. And
did you want to have a European or kind of European exposure in your role? Did you have to push for that, or was it kind of assumed, given that you'd come over from Sweden and you're the obvious candidate for it?
I applied to CBRE. I can't remember if it was CB Hillier Parker that I applied to, or CBRE at the time. And out of the applicants, they picked myself and a guy called Michael Riccomini, who was educated who's a Brit, having come through the British schooling system, for this European rotation. The idea was to encourage European integration and sort of give people a network around the offices around Europe. So I don't think necessarily it was just that I was a Swede. They maybe saw some other qualities that they thought would be beneficial and help this be a good idea. So, but it was when I spoke to them in the interview, I sort of said, I'm sort of very excited about being in London. It's a fantastic city and I love the UK. I would be interested in working in places like Madrid, and Russia at the time, if that's an option. And I'm happy that it was Frankfurt. I would have been happy in Russia as well, in Moscow as well. But so it was probably a bit of a combination of them looking for somebody to do that and me being very excited about doing it.
And your role was investment advisory, or is it kind of more analytical?
So the first part was with CBRE investors in London. So that was on the fund management side. I worked with a great team there. It was a very exciting time for that part of the business. It was growing. There was a great leadership in London and a sort of strong, expansive leadership from coming out of Los Angeles. So that was a very, very interesting, fantastic learning. The investment advisory in Madrid and in Frankfurt was, I joined the teams there and worked on the transactions, mainly buy-side transactions and once again, lucky to have had the opportunity to work on some very interesting deals with some interesting people.
You did a stint at Fitch Ratings as an analyst, where you did European structured finance. Why did you make that move? And I'm assuming you moved from kind of equity investment to kind of the debt side. Why was that?
After Frankfurt, I moved back to Madrid, and the idea was to set up CBRE Investors in Madrid, which I thought would be an exciting next step. The that didn't quite materialize at the pace that I was hoping for. So as I was considering my options, I thought London, New York might be a good next step for me, having spent 3 years with CBRE. It was a time when CMBS was starting to become a thing in Europe.
Commercial mortgage-backed securities.
Exactly. And with my interest in finance, I was intrigued by how you could take what is an asset class with somewhat limited liquidity and package it and structure it and securitize it and create a liquid product. So I thought, where can I go to see a bit more in detail and then firsthand what this looks like? So I joined Fitch and their CMBS team in London, and which was interesting.
Why was it so interesting?
I found I was a bit perplexed, if I use that word, with the incentive structures between the rating agencies in working with the banks in structuring and rating the tranches, the different tranches of the securities. I thought that was an imperfect setup. So it was really interesting to see that. But when my old boss from CBRE Investors, Giles King, called and said, "Hey, we're about to launch a new opportunistic fund here. Are you interested in coming back?" It felt like the right move, and absolutely nothing against Fitch. It was I had a good time there, but it felt that it wasn't quite for me what I was seeing, and I would rather go back and sort of be on the real estate side.
Before we get on to that move back to CBRE, for someone listening to this, can you just explain the relationship between a rating agency and a bank doing the CMBS piece?
For those who enjoy movies, the Big Short covers this in great detail. And I, without naming names, a friend of mine was very central to developing the rating model for CDOs, which was collateralized debt obligations, which was a step further complicated than CMBS. CMBS is not complicated in itself, but there is a potential for conflict in the way the rating agencies are paid if they get to rate the tranches, the CMBSs, you've got three main rating agencies in Standard & Poor's, Moody's, and Fitch, and not all three are going to get the job. So there is a potential there for a conflict of interest between the desire to get the instruction and the diligence, maybe. And I'm sure I haven't worked in this space for a long time now, so I'm probably speaking about old situations, but I'd like to think that has been resolved. But there were back then, pre-GFC, there were
misalignments.
Yes, I think.
And the main thing is, if it's AA rated, it's a better quality or lower risk product than something else, right?
Yes, you took theoretical mathematical formulas and applied probabilities situations, and in theory over a great number of underlying loans, the probabilities could be perceived that was a good assumption. But as time evolved and the market changed, probably some of the stress tests could have been more stringent.
To put it politely or politically. So you went back to CBRE to join an opportunistic fund?
Yes, that's correct.
What was the role there? What was the fund investing in? What were the target returns and what were the geographies that you were looking at?
So it was the second in a series of funds, that opportunistic funds that CBRE Investors in the UK was launching, and the team had done a great job with the first fund that was being exited as I joined. Second fund was materially larger, so we were buying. It was 20, like many of its peers. It was a 20% IRR fund, and we were looking hard for deals to make that work. And it was I think the UK, from when I got here in 1999 through to post GFC, there was a great momentum. There was great positivity, and there was great growth, and it was an exciting place to work. And we were in there. It's 2005-06. We were able to buy really well, and in more vanilla type deals. Not that they still needed a lot of work, and it was repositioning, redevelopment, and everything. But it was offices and industrial predominantly. It got more challenging with the third fund as the market got more expensive, and it became harder to invest the capital. But it was a lot of hard work, and a very rewarding time in many ways. It was a really, really good opportunity to learn, and to learn great things about how to drive performance, generate IRRs, urgency, the importance of urgency in turning things around to deliver those IRR targets. It was a time when debt was readily available, and our funds, like many others, were quite highly levered. So it was also a humbling experience in the benefits but challenges that come from leverage, and then the importance of timing.
You were with CBRE from 2005 to 2009. Can you just talk about some of those lessons and those learnings that you just alluded to, just in terms of the humbling experience being heavily levered and the market turning?
Which part is there a particular part you want me to focus on there? Because there's
or just give me a couple of different examples, maybe of some situations where you kind of, took some proper learnings from that have maybe informed how you view risk and manage and mitigate risk today.
Well, ample number of examples. The one thing, we bought a portfolio of secondary/tertiary industrial estates across the country, and I'd say we had a very robust process in how we approached deals, and we really challenged it. But we looked at for several of them where we were unsure about the likelihood of the operator remaining in operation, for us to be able to find an exit that would work on just restructure the lease and exit longer or better income, stabilized income. We looked at underlying land value, and I remember a deal where we had bought it, and we discovered that there was an opportunity to use part of the land for landfill, and there was an adjacent recycling center, and they were keen to buy it. So we could have sold the property with a very healthy profit, particularly with the somewhat limited amount of equity we had put into that point. And we thought, actually, there's more upside here. And looking back, the timing to go through planning to get residential consent, to change of use, to work through that process, was, when you look at the timing and the IRR focus and the number of assets in the fund, it would probably been a good idea to just sell it and take the profit. And I think that and it's different depending on the investment structure and the investment and return requirements you're looking for in the investment horizon. But if you're looking for IRR, trying to identify quick turnarounds that hits your target return is no bad thing.
Especially if you can cash out or trade out of something quite quickly at a super profit, and a couple maybe lag, a blended percentage will enable you to kind of maybe hit or exceed your target. So cashing in or knowing when to trade and when to sell is important. And
I think another learning is particularly when you buy things for sort of a higher return with higher risk or more moving parts. Another thing is that was very useful, was to keep an open mind as you go through, because you have a business case, business plan, or a base case business plan, and you have a downside plan and you have an upside plan, but chances are that things are going to go differently, and to be able to have an open mind and to be able to react to that is also very helpful, and to remember that to be prepared to think outside the box and take the time to make sure you reflect on the different possibilities as you go through the plan. And then numerous of examples where we bought something with one plan and ended up exiting with an entirely different route.
You'd been employed in the commercial kind of real estate space in the UK and across Europe for kind of 8 years at this stage. In the back of your mind, has there been a case of, family business back home, I need to get some skills to kind of maybe take that on in terms of the future, or was that not a thought or consideration?
It wasn't, at this point it wasn't, because the family had sold out of most of the businesses by the second half of the noughties, and they'd looked at a couple of things, but for one reason or another decided to not pursue them. So that wasn't something that was on the horizon for me.
So that wasn't an option. So that probably leads us into Trinova. When you set the business up, if my date's right, August 2009-ish?
Yes, we started, the discussion started earlier between the people who founded it, myself, Ed Costello, and a friend called Franz Habel. Probably started early 2009. We were actually quite close to setting it up as a new department within CBRE Investors. The negotiations sort of fell on the finish line almost as we couldn't quite agree terms, and it being something where we felt that, not afraid to be contrarian in our thought process, we thought there was an opportunity a lot of people were running for the door in central London. People were blanket negative to offices in or anything that had perceived risk, and understandably the people thought that many people were feared that the future had significant potential downside with what was going on in the financial world. And we felt that looking at, if you're able to buy good quality, really good quality office buildings in good or great locations in London, with long or medium term income for yields that haven't been seen in a very long time. So we're talking 7-8+% net initial yields. That is an interesting thing to pursue. And from conversations we were having with investors, the appetite at the time was, we felt more for sort of tailored separate account mandates rather than commingled fund for a period, and we thought that was an idea that we wanted to pursue. And as I said, we were close to setting it up within CBRE Investors at the time, but we, as three guys in our mid-30s, thought we can do this. Let's do this on our own, and which is where the journey started.
So is that where the name Trinova comes from, the three founders? And did you meet them at CBRE? Is it you all work together, or?
So Franz I met at university in Stockholm, and we remained friends. He's a close friend. He moved over to work at Bank of Ireland in 2008, and as return opportunities with offering potential for good returns were hard to find in the UK, we thought, as parallel businesses, then both of them, to Ed and Franz, who worked together and at Bank of Ireland, and myself at CBRE Investors, decided to go to Ukraine because we heard that that was still an immature market with lots of upside, and there were a couple of other international investors that had gone in there. So we got to know each other. I got to know Ed well on that trip and around that trip, which was a story in itself. But we decided on leaving from the trip that we're not going to go there to invest.
And then where did the name Trinova come from?
So as we were setting up the company, we were discussing names, and we needed to get something on the presentation for for a potential investor meeting. This is autumn 2009, and we're debating what do we want to call ourselves, and we sort of looked at what history of London, old history of London, and it turns out one of the old tribes that lived in are documented to have lived around here, whatever it was, 2,000 years ago, was called Trinovantums, and we thought Trinova sounds good, works internationally. Let's take that.
There's three of us. The tribe piece.
The three of us,
that.
yeah. So it's yeah.
Nice. So you started the business off September, autumn 2009. Did you have a business plan? Did you have a strategy? You kind of touched on the fact you thought offices maybe were oversold or there was an opportunity there. Outside of that thesis, how did you go from an idea to setting the business up?
A lot of hard work. What we thought was the market has corrected quite dramatically in pricing. We would like to offer investors a tailored service provision. A number of investors we were planning to target, or that we thought would be good targets, were overseas investors, both institutions, Swedish institutions among others, and family offices and high net worth individuals. And we felt that offices as an asset class or as a sector translates well across borders. So we thought, let's focus on that. It's also in one of the sectors where we as a team collectively have good experience, and where we were able to find conviction around what we thought would how the evolution of the recovery cycle would look like. So the plan was, hey, this is a great investment strategy. Hopefully it will be appealing to investors. We wanted to build something that we shared, was we wanted to build a business that was exciting and that was really took pride in delivering a great service and working. We thought about, do we want to set up a fund, or do we want to start with separate accounts, and because we're funding this launch ourselves, putting £250,000 or euros, I can't remember, with the FSA as it was then called, to start raising money for a fund wasn't necessarily how we thought our capital was best used. So we said, let's start with separate accounts and identify individual investors that share our conviction around where things are going and the timing and the recovery. And it also allowed us to, one of the things we wanted was to work closely with a handful of investors rather than trying to be everything to everybody. And we were lucky, and we met a handful of fantastic investors that we have been very lucky to work with over the years. Half of them we still work with from the early days.
Chicken and egg, it sounds like you got the strategy, got the idea, got the conviction, and then the hard thing's going to find the capital. Was that really difficult, just to identify the capital? And was it sovereigns, pension funds, high net worths, family offices? What type of capital were you ideally looking to be paired with? Or is it a case of, we've got to take any capital on any fee basis, let's just get a couple of runs on the board, and then we can kind of pivot and grow it from here?
It's a good question for us. We were, looking back, a bit naive in our presentations. We say this is a great time. The market is very volatile. Values have fallen a lot. It's a great time to invest. And we went to see a number of investors, LPs, institutions, who said, that's all fine and well, but I already own 4 buildings that are so my house is on fire here. Yeah. I'm really sorry, guys. I'm not focused on adding to new assets to the portfolio at the moment. And there was, so for us, we had to work hard to identify people who had enough capital to meaningfully invest with us to get the business off the ground, and who weren't in a situation where their existing assets were causing them too many problems. So it forced us to focus and think long and hard about who to target, and we got some ideas wrong about who would be a good target, and we got a few right, and we were found some very good investors to start with.
Quick one from me. If you haven't already subscribed or followed this show on the podcast or app where you listen or watch, please do. It takes 10 seconds and helps tremendously. I've got really big plans for the People Property Place podcast, and that one small action really, really helps grow the show and the presence and enables us to keep doing what we're doing. So if you haven't already, please follow or like on the platform you watch or listen to. Thanks so much. Talk to me about the first deal that you did.
The first deal we did was 19 to 20 Knoll Street, which was a deal where we put some of our capital in alongside a Norwegian bank.
And that's in Soho,
bank.
Right?
That's in Soho. It was, I must admit, not the prettiest of buildings, but it was cheap, and we got it for a price that we felt that the downside here is a bit of a no-brainer. The protection you have in the worst case scenario, and the upside is very significant. And it was a smallish deal, but it was one that we cherished because it's I can't remember. I think we bought it for like 7 million or something, and we were working. It was an interesting one. Speaking of timing, and it was an IRR focused investment with this bank, and we were having these ideas. You could extend it. You could change the facade, which, as I said, wasn't necessarily the prettiest. We buy in the building next door to create better floor plates, and in the end, the market moved so that we were able to exit it without having had to do too much work, and we got a great result from that. So that was a few years later, but that was a dear memory for us in terms of the first deal we did and the performance from that.
Amazing. How did you then start building the business from that first deal?
We did follow-on investments with the same Norwegian bank, which all worked very well for us and them. And so that was a useful start. We secured our first large separate account mandate which is the international real estate arm of Stena, the shipping group, Stena Realty they were called, which sort of allowed us to take a big step in terms of the size of the assets we were buying and the growth of the portfolios. And it was and they were a very, very professional investor, and it worked well for us with our tailored service offering approach, where we said we're very happy, we're keen to work as your sort of arm here in the UK, and they had a team in Amsterdam as well as in Gothenburg in Sweden, that we worked very closely with, and that was a very fruitful and successful cooperation.
The three partners, how did you split your roles and who did what?
When you start as three people, you are the head of photocopying, printing, coffee.
Deals, underwriting, financing.
We had slightly different backgrounds. So I was more on the asset management with my background for an opportunity fund where I was responsible both for sourcing deals and doing deals and then managing them the way things were structured. Ed was very much a transaction focused with an accounting and finance background as well as investments. And Franz at the time was focusing more on the investor relations, equity raising side alongside with me. So but when you start out, you get to do a lot of everything, and it's. I still remember when we went to pick up the camera to record ourselves to prepare for the first investor pitch we did, and somebody was responsible for finding a printing shop back in the day and running down with a USB stick. And so that was, the roles fell fairly naturally, but it was very overlapping.
Worlds apart from a big international global investors platform that you'd come from, right? So
very different, very different. But exciting at the same time. It felt very meaningful, and we shared a view and a plan for where we were going, and it was I don't think any of us minded booking the tickets, flying on the cheaper EasyJet flight earlier in the morning than what you would normally have liked to book, because we knew we were building towards something.
What was the personal cost at the time of setting up the business?
Well, it was a meaningful time without salary, and then things like, I remember balking at paying £700 for the photo shoot for our photos for presentations when we're and there were lots of costs that were small. And then actually we rented an office as well, serviced office, behind Royal Exchange, I think we chose not to look at the burn rate. It was
just ignore it.
Yeah, blinkers on. We can do this.
Let's ignore it. Just only focus on new deals.
Yes, and yeah.
So you transitioned from kind of being an advisor to doing deals on a fee basis, to then kind of moving through and start co-investing and becoming a bit more of an investment manager with some participation.
Yes, we co-invested in the very first deals we did as well. But as the company grew with some of our separate account mandates didn't want co-investment capital. They wanted full control of the capital structure, but as we grew, it was an interesting journey to go from 3 people to recruiting our first employee who's still with us back in 2010, and then as we started buying more, we grew the team gradually, and we continued to focus on separate account mandates for some time, and we were busy buying for the sort of best part up until 2014. We toyed with the idea of raising a fund as we sort of 2012, 2013 saw the regional office market open up, which had been sort of, in our view, paralyzed for a few years because they realized that it was too uncomfortable to admit where the actual values were. So they just said prime yields are this, and everybody sort of said okay, but no transactions happened because buyers didn't necessarily agree. But when that market started to thaw, what we said, should we set up is this a time to set up a fund, a commingled fund? And we decided against that. We went for a club structure instead because it was easier and faster to get to the market, because we thought 2013, if we spend 2 years raising a commingled fund, the market opportunity might not be there. And I think looking back, one of the things where we were scarred by the previous, the sort of 2007, 2011 journey. So we now are underwriting forward looking. One of the things we probably got a bit wrong was that we were too cautious about where we think, because we said, okay, average yields in any given market is this. And then if we're not the best property, and let's add a little bit on as our exit assumption. And what that meant was that with those exit assumptions, it limited your buying window quite meaningfully. And what we since realized was actually whatever the average is going to be distorted by what the yield was, because typically it's not weighted by transaction volume. It's sort of what year 2009 the yield was, whatever it was 2007, it was meaningfully different, but they were given equal weighting, even though the majority of transactions happened 2005, 6, 7. So it was probably lucky that we didn't go out with our underwriting assumptions back then, didn't go out and raise a fund. It took 2 years to do that, because that window closed quite quickly.
You'd have missed the window.
We would definitely have missed that window. Yeah.
So rather than doing separate accounts with individual investors, you did a clubbed structure.
Exactly. So we got our first more LP type investor to anchor that, together with a family office in our capital, and we're able to pursue that and do some good investments in there, really good investments, for taking very low asset level risk. But then the window closed as one of the UK institutions came and paid a very different yield from what we had been targeting as a price, and they reset the market. So.
And what year was that?
13, 14. So second half of 2013, early 14, I'd say the regional office yields moved by 100 basis points in 6 months, maybe.
Not in your favour.
Well, for what we'd bought, yes, but for what
Okay.
we were,
What you're looking to buy.
what we were hoping to buy, not as helpful.
How big was the team at that stage?
We had set up the in-house property management arm, so we were probably 12 people at that point.
And how much under management, roughly?
From memory, maybe 350
Nice.
at the time. Yes, that way. Yeah, it was. We were, on one hand, we were happy about it. On the other hand, we had set our targets higher than that.
But by this stage, profitable, proved the business, done some transactions, given some good returns to investors, kind of moved it on to a bit more of a club structure. You pivoted away from just offices. Can you just talk to me about when and how maybe the strategy has evolved as well?
The strategy's evolved in that we started by central London core, and then sort of staying ahead of the curve as we got more confidence around the recovery, and we moved into sort of central London core plus, and then value add, and then into the regions. So we adjusted the strategies depending on what we felt offered the best risk-adjusted returns. And we often joke and call ourselves real estate nerds in that we love analyzing information and data and identifying trends or change, be that from a macro urban landscape perspective, or be that pricing change and sentiment change or other changes that we can identify. But so we were able to adjust to that. By 2014, we started seeing some of the investments we had done early on where we felt that there started to be more risk on the downside from holding it longer as opposed to what upside potential they had, and we started exiting a few deals. And by 2015, we had exited a meaningful number of our tactical investments that we'd done to that point. And we looked around and we thought, okay, this has worked well. Although, as one of the investors told us, we'd rather you had done twice as many deals for us and got half the return, because our return that we delivered was significantly higher than the target return, and then maybe your underwriting was a little bit conservative. And said, that's fair. And we if we could go back, we would probably do that slightly differently. But hindsight is always easier than forward looking. So by 2015, 16, we thought offices are exciting. They are a great asset class and great sector, but myself and another senior member of the team, had quite extensive experience in residential real estate, and I actually gave my presentation in 2000 to CBRE. Pick a free topic. I picked the topic of why the UK should develop a professional rented sector, real estate sector. And so we've been sort of toying with that idea for some time and spoken to, among others, one of our separate account investors about doing it. So 2016, we started pivoting a little bit our focus towards the residential. We added the residential sector, and that a combination of reasons. We thought it from a business point of view, it made sense to diversify. From a risk return perspective, we felt that it was a good complement. There were different drivers for the residential side as compared to the commercial side. And we felt that it made sense. So we started slowly positioning ourselves in the residential sector, which now out of the 1.5 billion that we have under management, we were 0% residential in 2016. We're now 40%. So it's been a great growth part of the business for us.
You touched on you had residential experience, and there was clearly capital and LP interest in doing residential. Did you have to hire someone specifically to front and lead that strategy, or was the capital comfortable enough with your business plan and conviction and in-house ability to execute?
We did not have to hire somebody. It was a combination of myself and one of our colleagues who had experience in the residential sector. And so one of the mandates was a Swedish mandate where they had at the time, I think, 28,000 apartments around Europe. So it was a sector that was very familiar to them. So that was a good combination for us. And then we were able to grow from there. We expanded into student housing. It's sort of been a steady growth. We sort of supercharged it a bit in 2021 when we felt that we prefer to invest when we have conviction that the downside scenario, what we do is you break even. Your base case is that you hit your target projected return, and your upside is on top of that. And we started becoming less and less. We struggled to find conviction. We spent a lot of time trying to figure out where the office market is going, what the different sort of dimensions of change that was happening in the office market, in the occupational market, in the world, how that would play out. So it worked well for us that when we looked at the residential side, we identified subsets of the residential sector in the UK where we saw great value, a lot of low-hanging fruit. I often get kicked by the members of the team who actually have to do the work, but I from my perspective, it's a great way to invest. You can buy from landlords that have often owned these for a long time. Some of the things we buy in the HMO space, for example, where we very impressive portfolios, owners that have built it up over a long period of time to very impressive sizes of portfolios, but they have perhaps not had to, in all instances, drive them so hard because of when they bought in. So we find that you can come in, you do a lot of work up front as you buy it, and then the yield on cost you can achieve with the repositioning you need to do because there have been changes to licensing requirements and so on that some of the owners, let's say a gentleman in his 80s might say, do you know what, I've done well out of this, I've had a great cash flow, it's time for me to sell out rather than take on the work of repositioning this.
Massively so. And they built it to a particular size, tax legislation, other things are changing. It's an opportunity to trade out, as you said, having taken a very good income stream for the family.
For 20, 30 years.
Big lump sum at the back end, and then you can drive your returns through active granular asset management, which I guess is what you're alluding to, your team.
Yes.
Team having to do the heavy lifting.
Out of 55 people in the group, I think something like 20 work on the operational side and do a brilliant job. And the CEO for that part of the business, she's the one who often kicks me when I say this is so great. It's like you buy it for X, you only have to spend Y, and then
look
the
at the
yield on
returns.
cost. It's amazing. Yeah, there's a lot of work that goes on behind the scenes, but so that has worked well. So the residential pivot was fortuitous.
Yeah, quite, because 2016, I remember, resi wasn't necessarily a sexy word. It's definitely not as sexy as it is now. And there's a lot of managers right now who are, and have been over the last couple of years, looking at their business thinking, how can we how can we access the residential market, and do the partners or the founders, do they have the ability to do it? Because the capital's there, they find themselves maybe passing the mandates on to other platforms, and they're thinking about that. Do we hire someone to front it, to give capital confidence, or how do we structure it? Just interesting to find out how you did it back in 2016. You've also set up special sits part of the business. Can you just talk to me about the rationale and the thought behind doing that? And you've also got an asset management and a property management side too that you alluded to earlier.
That's correct. It's widely documented that there is a lot of stress in capital structures around Europe, many parts of the world, where the availability of senior debt or solutions for the debt side of the capital structure aren't always readily available. So what we thought was we started working with a couple of investors' credit funds and talked to a couple of our existing LPs about exploring that area. And we spent a lot of time working with that. And there are bigger funds that do this on much bigger scale. And a lot of funds have been raised to solve the situation in Europe and elsewhere. For us, it was one of my colleagues spent a bit of time with one of the investment banks, not least on the credit side. And we thought it would be a good opportunity where we could bring a combination of an understanding of the real estate with the credit side, with the debt side. And it hasn't come through as quickly as we and many others, I think, expected. But we've been able to successfully place a good amount of capital over the past little while into this space. We've had many stop and start situations where it's working well. It's working well. There's some really interesting opportunities out there, but there's growing competition, and there's some great people doing it, and then you have a number of people that are in most situations more suited probably than we are, but we do have situations where we find we can add real value and be a great partner to somebody who wants to place capital, and we can bring some interesting situations that we sort of see from the direct real estate side, and where we have conversations that have opportunities.
You mentioned you decided not to pursue a fund in 13, 14 and do a kind of a club deal instead. You have subsequently raised a dedicated fund. Why did you decide to do that, and when did you do that, and what is that fund's kind of parameters or themes and focus?
In 2016, we took a decision as a business that we'd been doing really successful work investing and then exiting, and we thought, as we were planning for the future, the first step of the plan was to build a company that was exciting, that worked closely with its investors and had great relationships and did great work. We realized to build a business, you buying, repositioning, and selling out at high frequencies works well for everybody as long as you do well and you get promotes and all that. But actually, if we want to grow the business, we need to take a slightly different approach alongside our current approach. And so we thought it was a good time to set up a fund, to launch a fund, a commingled fund. And we decided to get FCA regulated, which was quite the undertaking. And we did so sort of 2016, 2017. We then started the equity raise. We had a couple of target geographies for our LPs, the weighting of the LPs. And we spent a lot of time doing that. And it was a long exercise. And we were talking to both institutions and to family offices. There were the UK PLC as a target market after Brexit, and then with political uncertainty, and I particularly remember one investor who balked at watching Theresa May dance on TV, and genuinely gave that as a reason for not wanting to pursue, because he wasn't convinced that was the leader the UK needed at the time. And not giving my opinion on that, but just to give you a flavor of the challenges. And in the end, we got to a first close in November 2019. Really excited about the first close, keen to get the second close institutions in, because they got two of them said they can't be first close investors, particularly not in the first fund. So that was fine. We were cautiously optimistic about the market. We were seeing interesting buying opportunities in the value add segment of the office market. It was an office fund. And so we started 2020 excited and optimistic about being able to buy
some value add offices.
Buy some value add offices. We had the first deal under offer. Great office deal, I believe it would have been under different circumstances in Scotland. And then we all know what happened in Q1 2020, which caused a big challenge. And so the two large institutions pulled out. They said we were not investing at the moment. We need to understand where the world is going. So what we did was having found conviction around that the world was not going to come to an end, that there was still a future for offices, and that it was actually an even better buying opportunity. We found a JV investor to come alongside our fund to grow it, to make it a bit bigger, and we subsequently were able to invest in four office buildings around the UK and the regions, which at the time we felt were very good acquisitions. They're fundamentally really good real estate, great potential. The recent past has, I think very few people would say that the past year and a half has helped, with the geopolitical situation has helped the asset with inflation and all that. But we're able to, and actually over the last 6 months, it's been really encouraging to see the sort of the positivity come back, and the bit of, particularly after the summer, that animal spirit seems to be hopefully returning. We're certainly seeing signs of it, and we're seeing great things happening, and we're able to in these buildings offer tenants great space solutions and occupational solutions. So we feel that we're getting back to where we wanted to be.
You need some luck in the kind of the investing game. I guess you're pretty lucky that you didn't raise the fund 6-9 a year earlier. Start deploying the capital then.
Very true. So maybe I should thank Theresa May for
her dancing.
Yes.
And you're not the first person that said investors have looked at that video and said we're not going to be allocating capital to the UK based on that. I've definitely heard that before. You touched on kind of animal spirit post summer, and I think that leads us perfectly on to your views just in terms of the wider landscape right now. Where do you see the opportunity set, and what's your take on the market?
I think the residential sector has very good fundamental drivers underpinning it. Certainly some subsections of the residential market more than others. We see great opportunities there. I think you have a structural demand-supply imbalance that in much of the residential sector. There's a little bit of uncertainty created by some of the regulatory discussions and communications from the government. I think our view is that going through it, which we do continuously, we think much of the concern is misplaced. Some of the concern for certain segments of the residential sector are fair. But we do still see great opportunities to buy fundamentally good real estate that sits very comfortably in the demand-supply equation going forward for a long time. So we're excited about that, and we certainly will continue to invest in that space. We are optimistic about the journey ahead for offices. There's such a connect between what we're seeing in the occupational market for good office buildings, where we see strong occupier demand, we see great rental development, great rental growth, and I think there are certainly situations where something has fallen a lot in value. It might look cheap because the price is low, but actually it's not cheap. There are situations, there are assets in certain type of buildings, certain type of locations that are cheap for a reason, or low. The price is low for a reason, I should say. But it feels like there's been a broad brushed approach in many situations where people have said, "Wow, this building here, well, I'm concerned about the future." But we're from so much of what we're seeing, from so many of our discussions with tenants, with other companies, and our view is that it is important to be much more specific, asset specific, location specific, tenant situation specific in the analysis, and we see great opportunities in finding things that are finding ways to continue to drive performance from existing assets that we have through hard work, and I think there's a lot of chat about there's a lot of talk about the offices becoming more of an operational asset than it was. If you go back to the 80s, many leases were 25-year leases, and is not required and to be a proactive landlord in many cases. That has changed, but we find that by being a proactive landlord, and we as a business, we're a vertically integrated business, so we have as many touch points as we can have with occupiers, with the front desk staff in the buildings, with the people working on the building, and speaking to the tenants and understanding how we can help drive their enjoyment of the building and improve their enjoyment of the building, and drive performance. So I think I see really interesting opportunities there, both in successfully delivering on business plans of existing assets, but also buying going forward.
Doing the work, just doing the hard work to screen the deals, rather than just casting a particular sector with the same brush. Has your definition of success changed from 15 years ago when you set the business up, in terms of what your aspirations were, or not?
It's a good question. It's I think fundamentally no. We want to be a business that is a great partner to our investors, that is an exciting place to work, where people buy into our corporate culture of delivering, getting things done, and sort of looking around, being proud of the person to your left and to your right, and knowing that you're part of doing excellent work. That hasn't changed. I'm 15 years older than when we set up the business, so the perspective perhaps has changed, but I think so. In terms of the day-to-day, the essence of it hasn't changed. My view of where we're going with the business and where the partners are driving the business has changed somewhat, yes, over the years, as we've adjusted to be that geographical. We've expanded geographically. We've expanded the sectors we look at, but I'm optimistic about the next phase of the journey. I think the last 4 years, for many reasons, have been tough, but I'm positive about that. We're in a good place to embark on the next stage of the journey.
There's been a lot of movement in the market and a lot of new businesses set up, and there'll be a lot of entrepreneurs who are 6, 12, 18 months into the journey, who would look at someone like yourself and the partners and go, if I could just have a tiny bit of his success, that would be amazing. What advice would you give to a first-time founder embarking on the entrepreneurial journey, looking to set up a new platform?
I'd say patience is sometimes things that you want to happen take meaningfully longer than you want them to happen. And sometimes change happens and you have to react quickly to it. But I think that real estate is not a tech, it's not an AI app or a technology company, so it takes time. I'd say make sure to have people on the journey, to join people on the journey to that share your corporate values and the drive. And I'd say it is a very exciting journey to go on, but it's not easy. It is hard work. And I think speaking to other people in similar positions to me, it's been hard for the past 4 years in particular, on many levels, be that dealing with changing interest rates environments and valuation falls and things, but also corporate culture. And then the dealing with lockdowns and things have been taxing. But I think if for somebody who's come in now, if they're fresh and excited about taking that on, I think it's a really interesting time ahead.
As we draw to a close, Linus, the question I ask everyone on the podcast is, if I gave you £500 million worth of capital, who are the people, what property, in which place would you look to deploy that capital?
I would happily back ourselves to invest it.
No surprise there?
No surprise. I would say the residential sector, as I mentioned, I think that is a good risk-adjusted return, and there are different parts of it that there's some really interesting changes happening that offers value add potential, opportunistic potential in requiring repositioning around certain regulatory changes that have come through. I think the affordable segment of the not technically affordable housing, but sort of residential priced in an affordable price range, I think is a very good sector to be in, because you're catering for your normal average household, and you're able to, as long as you're able to buy in at a sensible level, you should have a resilient demand there. And I would say offices, where you buy well in the right locations. I do think we have seen for some time and it's accelerating the change. And I think the build costs, refurbishment costs, and forces rental levels to be set from a different perspective than historically. There's a new dimension to it in terms of which affects demand and supply and where rents go. So I think if you're able to navigate that wisely, and if you're prepared to roll up your sleeves and be an active manager, I think there are some really interesting opportunities there. So I would happily invest with the team part of the money there. We also do think there's still interesting credit situations available where you have, for one reason or another, fundamentally good real estate, fundamentally solvable situations, but where the capital structure doesn't have the duration to see it through to the other side, and where you can go in and provide that solution to the capital structure. So I would spread it, depending on the risk appetite of the capital, I would spread it between those three buckets.
Well, Linus, you've had a phenomenal career. You've done what many aspire to do, and I'm really excited to see what you and the team go on to do through this next cycle. And if I cast my mind back to 10 years ago when I was in your office on Lime Street, I remember sitting there, and I can't remember if it was you, if it was one of your partners, but I remember you bought the building from David Pearlman of Pearl & Coutts, and I think you just found out that there was a hidden wall or area in the business, area in the building that you didn't know, or he didn't know, was lettable space. And can you just recall?
We bought the building in 2012, and it was not being proactively managed at the time. And as we bought it for a very attractive entry price, as we went through and did the building survey, we were walking around the building. One of my partners sort of like, this doesn't make sense. What is this boarding here? This can't be looking at the rest of the building. There's got to be something behind here. So we did discover additional space.
additional value add space that you could let out. Well, look, you've hunted out deals and returned great value, and I'm excited, as I said, to see what you and the team are going to do through this next cycle. So thank you so much for joining me today.
Thank you very much for having me. It's been a pleasure.
Thanks for listening to this week's episode of the People Property Place podcast. If you found it insightful, feel free to share it with a friend or colleague. Give us a rating, like, or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of guests that we should have on the show or areas of the market we should explore further. So do drop me a message. The People Property Place podcast is powered by Rockborn. The team recruit leadership and future leadership hires for real estate owners, funds, investors, and developers. So if you're looking to hire top talent for your business, head over to the website www.rockborn.com, where you'll be able to find a wealth of information, or feel free to drop me a message on LinkedIn. Have a great day wherever you are, and I look forward to catching you